Japan just lost its title as the world's largest creditor nation. After 34 years at the top, Japan was overtaken by Germany in May. If you follow Japan news, you probably saw this framed as another sign of decline.
There's just one problem with that story. Japan's overseas wealth didn't shrink. It hit an all-time record. At the end of 2020, Japan held 3.7 trillion in net foreign assets. That's 3.7 trillion more invested abroad than foreign investors hold in Japan. That's a record. Germany overtook Japan not because Japan got poorer, but because the yen collapsed in 2020, making Japan's holdings look smaller in global currency comparisons. In yen terms, Japan's overseas empire grew 13% in a single year.
Japan didn't lose a race. Germany just crossed the finish line first on a technicality. The real story isn't about rankings. The real story is what Japan has quietly built over 4 decades, the largest privately held overseas investment empire in human history. And almost nobody outside of financial markets talks about it.
Let's start with what the numbers actually mean. Every year, Japan runs a current account surplus. The current account is the broadest measure of how a country is doing financially in the world. It captures goods exports, services, and crucially, investment income. For fiscal year 2020, Japan's current account surplus reached 3.10 trillion yen, or about $4,000 billion. According to Japan's Ministry of Finance, that's a record high for the 3rd consecutive year.
But here's the part that gets lost in translation. Of that $9 billion surplus, the portion that came from Japan actually selling goods to the world, the trade surplus, was only 1.36 trillion yen. The income from Japan's overseas investments, what economists call the primary income balance, was 6.8 trillion yen.
That's a ratio of 31 to 1. Japan's export economy is functionally an investment income economy. Japan earns more from dividends, interest, and profit remittances from its overseas holdings than it does from selling cars, electronics, and machine tools to the world. The factory floor narrative hasn't been accurate for at least a decade.
This doesn't mean manufacturing doesn't matter. Toyota still sells millions of cars, and Japan's semiconductor equipment makers still supply the global chip industry. But when you look at where the money is actually flowing, the overseas investment portfolio is now the dominant engine.
So how did Japan get here? The short answer is by not spending what it earned. From the 1970s through the 1990s, Japan ran enormous goods trade surpluses. Japanese companies sold televisions, cars, and machine tools to American and European consumers. Those surpluses generated cash. That cash needed somewhere to go.
It went abroad. Japanese institutions, pension funds, life insurance companies, banks, and corporations systematically deployed capital overseas. They bought U.S. Treasury bonds, European real estate, American companies, and equity stakes in businesses from Southeast Asia to Latin America. Each year's trade surplus compounded into a larger and larger overseas asset base.
The process had an elegant internal logic. Japan's domestic economy was aging. Returns on investment at home were low. Foreign assets offered both better yields and geographic diversification against Japan's shrinking domestic market. So capital flowed out year after year, building the empire we see today.
The 3 main pillars of Japan's overseas empire each operate differently. The first pillar is institutional capital, anchored by GPIF, the Government Pension Investment Fund. GPIF is the world's largest pension fund, with assets of roughly 1.8 trillion as of September 2020. By mandate, GPIF allocates 50% of its portfolio to foreign assets, split evenly between foreign bonds and foreign equities. That means GPIF alone has nearly $200 billion deployed outside Japan.
What makes GPIF important isn't just the size, it's the mechanism.
GPIF's foreign asset allocation is rules-based and largely automatic. Every quarter, GPIF rebalanced toward its targets, which means it is a structural, non-discretionary buyer of foreign assets, regardless of what the yen is doing or what's happening in global markets. It's a perpetual overseas investment machine built into Japan's retirement system.
Japan's life insurance companies form the second pillar. For most of the past decade, near-zero domestic interest rates forced Japan's life insurers to buy foreign bonds, predominantly US Treasuries and European debt, just to earn enough return to cover their policy obligations. By Nisen Asavov, the rising yield on Japanese government bonds triggered a partial reversal according to the Japan Times. Roughly half of Japan's 10 major life insurers cut their overseas bond holdings in the second half of Nisen Asavov as domestic yields became attractive again.
But even as insurers trimmed overseas bonds, they kept expanding overseas equity. Nippon Life Insurance, Japan's largest, has spent more than $3 billion on overseas acquisitions, and has publicly stated its intention to acquire more. The pattern is structural. Japanese insurers are rebalancing their overseas exposure from fixed income toward equity ownership, from being lenders to being owners.
The third pillar is corporate Japan. Japan's outbound M&A activity hit a record in Nisen Ashiguten. According to D-Logic data cited by White and Case, Japan-related M&A reached Thambri Hachiguten Kudol billion that year, up 33% from the prior year. The value of outbound deals alone jumped 87% to Shuhachden ni trillion yen. Japanese companies aren't slowing their overseas expansion because of the weak yen. They're accelerating it because the strategic logic of buying international growth to offset demographic decline at home is more compelling than ever.
None of this even counts the Sogo Shosha, Japan's giant trading companies. Think of Sogo Shosha as a cross between Berkshire Hathaway and a global logistics conglomerate. Mitsubishi Corporation, Mitsui, Itochu, Sumitomo, and Marubeni collectively hold equity stakes in hundreds of businesses across 6 continents: energy projects, food companies, infrastructure, financial services, technology. Mitsui alone reported 400 billion yen in annual profit from its overseas equity method investments in fiscal Nisenvaisher obtain. These companies function as Japan's unofficial private sector sovereign wealth funds, patiently compounding overseas ownership across generations.
Now for the paradox at the center of this story. Japan runs the world's largest investment income surplus. Its overseas empire generates tens of billions of dollars in returns every year. By conventional logic, all this income should flow home, strengthening the yen.
It mostly doesn't. The income earned overseas is, to a large degree, reinvested overseas. GPIF's returns get rolled back into the portfolio. Japanese corporations keep earnings in their foreign subsidiaries to fund further expansion. Life insurance companies use foreign dividends to buy more foreign assets. The mechanism that generates the income is also the mechanism that keeps the income outside Japan.
As a result, the yen has remained structurally weak even as Japan's overseas wealth has hit records. The yen lost 11.7% against the dollar in Nisen Isher Sif alone. The same year Japan's net foreign assets grew 13% in yen terms. The two facts are directly connected. Weaker yen inflates the yen-denominated value of foreign holdings.
This creates what analysts at Amundi Research describe as a potential systemic risk in reverse. Japan's Santien Liu Dol trillion in overseas assets subject to carry trade dynamics represents a kind of financial dark matter in global markets. As the Bank of Japan continues raising interest rates, the BOJ raised rates to 18% in January. Nisen Arsuwu, the highest since Nisen Hatch. The calculus for keeping that capital offshore gradually changes. Higher domestic rates make Japanese bonds more competitive. The structural incentive to deploy capital abroad weakens.
Japan also holds more than $1 trillion in U.S. treasuries, making it America's single largest foreign creditor. According to Jetro's Ich-sen Archivor U.S. Investment Dynamics report, Japan's total U.S. investment position reached $780 billion. When analysts talk about the yen carry trade unwind, this is the specific mechanism they're worried about. Even a partial repatriation of Japan's overseas holdings could meaningfully reshape global bond markets.
This is the part that matters most. Japan's overseas empire is not an accident. It's the accumulated output of 40 years of systematic capital export, driven by three structural forces that haven't changed and won't change quickly.
First, demographics. Japan's population has been shrinking since Nisen sustained domestic economy, with 17% of its population over 75 years old cannot generate enough return to satisfy the capital needs of a $1 trillion asset base. Overseas investment isn't optional, it's how Japan's savings system survives. The Daiwa Institute of Research published a report in April Nisen ni Ruk noting that Japan's record current account surplus is increasingly driven by offshore income rather than domestic production, and flagging this as a structural challenge.
The surplus doesn't directly stimulate Japanese workers or factories. It enriches asset holders. That tension will define Japanese economic policy for the next generation.
Third, and most overlooked time, Japan has been accumulating overseas assets since the 1980s. Compounding works slowly and then all at once. The $100 trillion yen asset base that exists today is largely the product of 4 decades of reinvestment. Germany's overtaking of Japan in the creditor rankings is real, but Germany reached that position in roughly 15 years of post-Euro current account surpluses. Japan's position is the product of a generation.
The headline was Japan lost its crown. The reality is Japan built something that has no historical precedent. A private sector overseas investment empire of $780 trillion, constructed through 4 decades of disciplined capital deployment, generating hundreds of billions in annual income, and underpinning the financial stability of the world's 4th largest economy.
The lost decades narrative will probably never fully die. It's too clean, too convenient, too useful as a cautionary tale. But while commentators were writing Japan off, Japan was quietly buying the world. The only question now is what happens when Japan decides it wants some of that money back.